most of the ones that I was the main GP on.
Okay.
I was the boss. I was the main GP on all the others. Kind of gotten rid of those, and now I'm more on the LP side and helping others get involved with that business.
Hello, everyone. We're Jacqueline and Melvin Landry, and we welcome you to our podcast, Get Diversified. Throughout these series, we'll cover all the topics and questions you have about investing in apartment buildings, storage facilities, and mobile home parks. Being knowledgeable in these areas will help you feel more comfortable about investing. Apartment investing equals building wealth. Building wealth equals financial freedom. Achieving financial freedom allows you to spend your time with building memories with your loved ones. Let's face it, time is the one element in life that is limited, and you don't want to waste it.
All right. Hello, folks. How are we doing? I am Melvin Landry, and welcome to Get Diversified. I want to introduce you to our next guest. His name is Jeff Greenberg. Jeff has a wealth of knowledge and experience in the real estate space, as well as the fund space. And we're going to talk a little bit about funds, what it means for you, an opportunity to get involved from that standpoint as well. So, Jeff, welcome to the show, sir. How you doing?
I'm doing fantastic, Melvin, and I appreciate you bringing me on.
Okay.
This is going to be fun.
It is. Well, I've been knowing Jeff here for a couple of months here. We're part of the same consortium. So got the opportunity to really get to know Jeff better and look at some of the wonderful things that he's doing, particularly in the real estate space. So, Jeff, why don't you go off and kickstart our viewers? Tell us a little bit about yourself, how long you've been in real estate, and what you're working on over there.
Okay. I call myself a recovering syndicator because for the past 12 years, I've been syndicating multifamily and student housing properties and been doing that all over the country, Texas, Arizona, Ohio, Georgia, all different locations, and kind of decided that I liked the equity side of it a lot more than I liked the operations and the management side of the business. And so I've been slowly selling off my properties and using that equity to invest alongside of my investors in some equity funds that I've created, diversified, customizable equity funds that I now have. And I'm having a lot more fun. Okay. So doing that.
Good. Now you talk about at one point in time, you had a pretty sizable portfolio. So what does that number look like? I mean, what's the largest amount of properties you've held under your tutelage, Jeff?
Well, I was involved in probably about 1,000 doors at one time. And actually now on the equity side, we're back up to about 1,000 doors. I'd have to sit down and count them a little bit, but somewhere around 1,000 doors on the equity side as well. But I've gotten rid of most of the ones that I was the main GP on.
Okay.
I was the boss. I was the main GP on all the others. Kind of gotten rid of those, and now I'm more on the LP side and helping others get involved with that business.
Okay. So, Jeff, why don't you mentioned you were the main, I guess, the lead GP on your other prior deals, right? So,
yeah.
You want to articulate for the audience in terms of to be a lead GP, what all does it entail? Because it could be a lot of work. Am I correct?
Oh, absolutely. And typically, first of all, we all know this is a team sport. And so you certainly don't want to be doing this on your own, even though I did do one on my own, and I don't think I want to do that one again.
Yeah.
But typically, if you're working with 2 or 3 main GPs, there's a lot of different things that you need to be concerned with. I mean, there's the acquisition side of it. So broker relationships, analyzing deals, going and doing your due diligence on properties, finding the properties. Then people think, oh, wait, hey, I got the property. We got it under contract. We're doing our due diligence. We're going to close on it. And we think, hey, we made it to the finish line. Not even. You made it to the starting line. Okay. That's like the Olympian that made it through the qualifying and now they're in the Olympics. They're just at the starting line. And then you've got your operations and you're dealing with, dealing with management, dealing with insurance companies, dealing with the lender, dealing with all these other pieces. And if you've got several people helping you, it's great. Everybody takes a piece and everybody's doing something. But that was more of the business that I didn't care for. I enjoyed much more working with investors, helping to educate investors, helping them to show them what a great business this is and how they can benefit from it. And so that's kind of where I moved over to the equity side, where now I just find good quality deal sponsors, those GPs running the deals, those guys that are really good at it. And then I'll help them by bringing equity into the deal and get myself into the deal as well.
Okay. Hey, thanks for sharing that, Jeff. I appreciate it. You mentioned the notion of top operators that you look for, top operators that you deal with, right? So,
yeah,
if someone's a potential passive investor and they're just kind of, they're inquisitive, right? They want to find that right operator, right? I mean, we all do. We all want to partner with the top operators who can do what? Execute the business plan, right? Try to get as close to the projections as possible from a return standpoint for the investor base, and hey, keep doing it again, right? Wash your hands and do it again. So what are some core attributes that you look for, Jeff, when you're vetting your operators out there in the market?
Well, I think the one thing is you're on the right path that we're talking about the operator first. A lot of times people come up to me and say, hey, how do you find good deals? And I said, first of all, you're asking the wrong question. The question should be, how do I find good operators? And then let's look at their deals. So you're spot on that part of it. I want to find operators that have integrity. What did they do when there was a problem? I want to know how they handled issues. I want to know how their communications are with investors, and especially when there was issues. There is always going to be issues on every single deal. Some are a little bit worse than others, but how did that operator deal with it? And, how their business plan. I want to know how their office is. Want to know who's in the office. What is everybody's responsibilities? And who's the main guy? The main person is the asset manager, which is the person that oversees the property management company.
Right.
Okay, that may be the main GP, that may be somebody else, but who is the one that's making the decisions and talking to the property management? That may be several people and maybe one. I want to know who that person is. I want to know what their experience is. So those are some of the things that I look for, but integrity is number one, because that helps me look at their numbers and believe them and have a little better feeling about their assumptions. How realistic is their business plan? So, I need to learn about that part of that business.
Okay, good. Hey, appreciate that response, Jeff. So typically when you're vetting, potential operators, do you tend to want to kind of get the entire team on something like this, a virtual call, to kind of speak to them specifically? Or, I know through conferences and meetings, right, which there's a lot of them out there now in the marketplace. Now, what are some other kind of pinpoints that you do to continually kind of vet a top operator per se? Because I would think, right, given your expertise and your history, is you don't just have one conversation. Oh, I'm going to go ahead and go with it, right? There's a series of conversations. There's a series of results that you want to see, right? Probably before you decide to put dollars or equity in that deal. Am I correct?
Mm-hmm. No, absolutely. And I'm probably a little bit slower than some people as far as to jump onto into a new opportunity with a new operator. I want to get to know them. Most of the operators that I'm investing in right now, I've known for years. I've known them for either years because I was in a mastermind with one group, another group that I've invested with. She was actually my asset manager and actually worked as one of my other GPs on the team. And I saw how she worked and I knew what she did. And I also knew the management company. And it was one of those things where I said, hey, let me know when you're doing your own deals. When you bring a deal in, and I'm there, I'm ready to know. And I've also known her business partner for quite a few years. So it does take me a little while to get to know people. Now, people do talk about track record, And there is a little bit of a problem right now with track record in that just about anybody could have a fantastic track record because of the last few years have been phenomenal for the business. I mean, even people making every mistake in the book could have done very well in the last few years. Now things are a little bit tighter, and now I'm more concerned about how they can handle things in this period of time, which is going to be a little bit more tumultuous.
Yeah.
You know.
Indeed. Yeah. So let's talk about these times, right? These are some unique times, right, in terms of the banking industry, right?
Mm-hmm.
You know, where rates are, right? It's not too favorable right now, right, for a lot of us. Thinking about, Jeff, let's think about the best kind of opportunity that you invested in the highest returns that you got. Was that as a result of you kind of being involved with that operator for, say, years or whatever? So you want to kind of share in terms of you've been involved in many deals, right? The very best deal that you've been a part of, but was it an attribute to the market and a great team, or was it an attribute of rocky times, but a strong sponsored team got it over the up to produce fantastic returns? Any type of examples you can share for the user base?
Yeah, the last one we did, the last big property, 225 units, Amarillo, Texas. We bought it for 10.2. Bought it for 10.2, put about $1.5 million into it, and then sold it in 2.5 years for 16.2. Okay, that's pretty phenomenal, and that was during COVID.
Wow.
Now, I was just looking the other day that we did some phenomenal things, and with all the great things that we did with increasing the occupancy and improving our tenant base and all the stuff, we probably should have gotten about a $14 million sale on that, from a 10.2 to a 14. And of course, I would say that the market gave us the rest. Right. So the market gave us another 2.2 million.
Okay.
We didn't really expect that, but it was there, and so we jumped all over it. So yeah, you can do the right things and you can improve properties, but the thing that you have to look at when you're looking for a deal sponsor is, let's pull back the curtain a little bit. And I did a presentation the other day at our local meetup, and I just got through telling them those same exact numbers that I just gave you.
Yep.
And I told them, I said, see, here's the numbers. I'm a genius. And then I went through the whole list. Okay, here's what went wrong. Here's what happened to the property. Here's all the different things. And the educational value to that audience was much higher on all the things that went wrong, the things that we missed, the things that we had to solve. That's a much better educational value than that first part I told you about how well we did and how great a return we got to investors. That I could go around bragging about all kinds of great deals that we did and brought investors great returns, but that doesn't really tell you the whole story.
Gotcha. Yeah.
There's so much more in that story, and investors learn a lot more from what went wrong. And so asking people, a potential deal sponsor, what went wrong and how did you solve it, I think gets you a much better education and gets you a much better understanding than telling, oh, hey, we got our investors a 30 IRR. And, we got them a 71% return in 2.5 years. I had another deal where we got investors 120% return in 3 years. That was a 40%. That's 40% annualized return. That doesn't tell you anything about the deal, though.
Yeah.
And it doesn't help the investors for their future deals and to understand this business. That all sounds good, but, unless they know really what we went through and how we had to pull those things out.
Yep. Makes sense. Transparency is the best remedy, right? Taking the good, the bad as well, and kind of sharing that from an educational standpoint is key.
Absolutely.
Good. So let's think about a deal, Jeff, that kind of you thought was fantastic, but it ended up potentially going a little sideways. I'm sure you may have you ever had any of those?
Sure.
In in your ecosystem happen to you from that standpoint? Anything you want to share in terms of experience to the audience base?
Yeah, the first deal we did, not that it went sideways, but we didn't realize that we needed to have some runway to make improvements. We bought a property, it was 3 years old. It was 20 units. It was actually 5 fourplexes in a cul-de-sac, and we treated it as a 20-unit property. Okay. And like I said, it was 3 years old. It was 100% occupied when we bought it. The tenants were already paying electric. It was in a slow growth community. It's kind of, okay, where do we go up? How can we add value?
Yeah.
Well, there was very little we could do. We tried to start raising rents. We tried to build back on water to get a little bit of revenue, but it was really, really tough. And so we were able to eke out a little bit of money for the pref for our investors. And we just kept trying everything we could to add value to it, but it was extremely difficult. And then at the end of the 4.5 years, when we decided it was time to sell, we were going to sell in year 5. We just couldn't get a price that made sense because the broker, what we were going to pay the broker was going to eat up most of the profits. And so we wrote down a number and we said, okay, if we can't get this number, we're going to hang on to this property till we can. Got an extension on the loan. The lender gave us an extension, and we ended up 6. So it took us another 1.5 years to sell it just so we had enough profit to give our investors some return. So they did okay. They averaged probably about a 7% annual return. Okay. They got their money back and they made about a 7%. That wasn't the 16% that we had told them in the beginning we were going to get them, but they still did better than they would have had it in a bank. Okay. So we learned a lesson on that. We call that our seminar. Because we didn't make squat. We got our acquisition fee up front. And we got a little bit at the end, but we got zero money for the entire hold because we were new and we didn't even put an asset management fee in there.
Oh, wow.
So we didn't make any money for those 6 years off of that property and worked our tail off. But we showed what we were made of and we kept the property going. We got it sold finally at the end. Investors were happy. Some of them are still with me. After 12 years, some of them have been invested in multiple deals with us, but we didn't lose anybody's money. We didn't make a great deal, but it was a good lesson.
That goes to show you, right? You put your investors' money and your investors' interests first before your own. And
absolutely,
you brought up a critical core component, right? Some of those guys who kind of rode that wave with you on that first one that was kind of rocket, they keep coming back and they keep rolling with you and they keep trying with you. And that's how you build rapport, you build relationships that way, and it's worked out very well for you. So great to hear. Thanks for sharing that example.
Yeah.
Hey, now tell the audience, Jeff. So you operate a couple of funds, right? So you want to kind of share some intel in terms of some of the diversifications of funds that you're kind of working through, and how's that going for you today?
Sure. So typically your typical funds that you go into, when you're in the fund, you're in anything that they bring into the fund. So, and they call those blind pool funds. And basically you are totally relying on the fund manager to determine what they're going to bring into the fund. Now, typically there's some parameters written out into the operating agreement that says this is what we're going to look for and this is what we're bringing into the fund. Yep. Basically, once they're in the fund, you're spread across all of those deals. Now, some fund managers may be doing it for their own deals, and maybe they're the only, they're running all of those deals, or maybe they could be other people's funds that this fund is investing in. Okay. Now, the fund I run, or actually the two funds I run, one's a 506B that allows non-accredited investors, and I have another one that's a 506C that only allows accredited investors. Now, both of those are customizable funds, which means that people get to choose which fund or which opportunity they want to be in. So if I bring an opportunity in, say short-term rentals, and someone says, no, I don't like short-term rentals, well, they don't have to be in that. Right. If I bring multifamily in and they decide, oh yeah, that's the one I want to be in, so then they could go and bring in and allocate money to that opportunity. I'm looking now at, say, self-storage. Well, maybe somebody wants to be in self-storage. They always get the choice before they put their money into the opportunity. And all of these opportunities are under one umbrella of the fund. Mm-hmm. And so at the end of the day or at the end of the year, they get 1K1 for no matter what number of deals they're in. And they could pick and choose how diversified they want to be. So they can be in different opportunities that some may cash flow better than others. Multifamily doesn't cash flow that great these days, but they still have some great capital appreciation at the end. So if I'm in something that maybe self-storage, or I'm looking also at RV parks, which do have better cash flow. I know some people are in ATM funds, which are all cash flow, no capital appreciation at all at the end. At the end, it's done. So people can pick and choose which opportunities they want to be in, all within these funds. And it makes it very convenient to go and add another opportunity, to get into another opportunity once you're already in the fund.
Makes sense. Thanks for sharing that. Hey, Jeff, would you say that the discussion points with your potential investors is a little bit easier because you're so diversified across so many different facets?
Well, anytime you're raising money in a fund, there's some hesitation. Mm-hmm. And most of the funds, as I said, because you have to be in all the different deals, scare some people off. People would be hesitant of the funds. So by being diversified and giving that flexibility, people understand that they get to pick and choose. And so I think that's a great opportunity for people, and being able to be truly, truly diversified, where, people that are in the stock market, okay, yeah, you're in the stock market, but stock market seems, when it goes down, it seems that most sectors of the stock market go down. Yeah. In commercial real estate, there isn't a lot of correlation. Some asset types do better while others don't. So self-storage does very well during recession and during good times. People are always having too much stuff to store. RV parks seem to always be filled. Now they may be a little more seasonal, mm-hmm. but even during a recession, you can go camping. And if you're one of these people that have bought one of these expensive motorhomes, even when gas prices are high, you're still going to want to take it out. And maybe you're not going to drive as far if gas is $6 a gallon, but you still, okay, you could make it 100 miles, or so to go camping just to get out of the house. A lot of people during COVID were getting the RVs just to get out of the house. And RVs, you're far enough away from people, so you can go out and enjoy yourself and enjoy the outdoors. So there's different asset types that, some people may like, some may not.
Others.
And so it's, it gives you the chance. You get the chance to pick and choose.
True diversification, that is best. Appreciate you sharing.
Yeah.
Thinking about the next 12 months, right? In terms of, your funds, right? How you're looking to diversify for the clients that you serve. What's your goal as a fund manager to really bring the needed value for your clients, say in the next 12 months?
Well, right now I'm evaluating a couple opportunities. I'm actually evaluating the sponsors, but I am looking at some short-term rental portfolios. I'm looking which are pretty good cash flow. Looking for the RV parks, which are good cash flow. Looking for self-storage, which has cash flow and also equity capital appreciation. Let's see, what else am I looking for? Those are probably the three that come to my top of my mind, but those are definitely good ones. I also want to get into assisted living. Assisted living certainly is going to be of demand. We've got an aging population, and I think that's a good opportunity. I'm still big on multifamily, and we just closed on one recently. But I'm very picky about the deals I get in, and I'm looking for fixed rate loans, low leverage, safe. I'm looking for the safety of the investors first. And I tell the deal sponsors, number one is tell me how you're going to protect my money.
Yep.
That's number one. It's not how much are you going to make me. Okay. First one is definitely how are you going to protect my money? And then once you've convinced me of that, then we could talk about the next step is how much money you're going to make me and how, and the risk levels. But I need to know how you're protecting the money. And that's critical, especially in these times.
Right. And if you notice, Jeff, a lot of the pitches that we see out there, right? A lot of operators out there kind of speaking out to, hey, here's the returns that that's going to bring, right? Projected. But you asked the question kind of inversely, right? How are you going to protect you and your investors' money, right? And if you do that, everything else should take care of itself at the end of the day, correct?
Yeah. I mean, if you're protecting my money first and then we could say, okay, what's the likelihood of you making me some money? That's great because everything you go into has some risk. So now is the risk and reward balance out? Okay. You don't want to get into something that's a high risk, but a low return. Okay. So you want to have some symmetry on as far as the risk reward profile.
Absolutely. Absolutely. Fantastic. You dropping some nuggets of knowledge here, man, for the user base, man, in terms of thinking about diversification. How should they think about their approaches to overall investments? And hey, how to vet operators as well as they're kind of going into and evaluating deals, right? Which is key at the end of the day.
Absolutely. Absolutely.
So Jeff, we think about, let's think about in terms of the next 12, 24 months, right? What's your goals in terms of how many deals you would like your fund to be a part of? What's the target amount of doors that you're looking to kind of get under from that standpoint, as you're kind of forward thinking from that standpoint?
Well, I don't really look at a target of the number of deals, mainly because I don't have to do deals, but I have investors that would like opportunities. So I want to bring those opportunities to my investors, and I will only do it when I feel comfortable doing it. And I have no pressure to do deals. I've got my expenses covered. I don't have to go and bring in opportunities. And I believe that my investors appreciate that I bring in deals when they're ready to be brought in, when I'm comfortable with the deal sponsor and the opportunity.
Okay. All right, Jeff. So as we kind of wrapping things up, we've got a few questions there I want to kind of throw at you. Think about the best piece of advice that someone has given you. What would you say? Which would you say had the best piece of advice been given to you over the years?
Well, it's probably the same advice that I give to new investors, potential investors. First, educate yourself. You have such an advantage with so many podcasts out there, so many great books out there. Educate yourself first, and then find somebody that's doing what you want to do and find a way of being of some service to them. Now, you need to be somewhat educated, otherwise you're just going to be a burden to them. So you want to find someone that, and it doesn't have to be in your area. It can be. If it's somewhere you can meet for coffee, that's even better.
Yep.
But depending on where you live, you may have to meet somebody that's farther away. But find somebody that's doing what you want to do and find some way to be able to assist them and help them with their business, whatever it happens to be. Don't ask what they're going to pay you. Don't ask what you're going to get out of it. Whatever education you get out of it is so much more important than anything monetary. So find somebody and figure out how you can be of help to them.
Appreciate that, Jeff. Now let's talk about social media. I mean, how do you see social media kind of in terms of the availability of information, right? And being able to take advantage of social. What's your viewpoint on that in terms of someone who's new, who's wanting to kind of explore more into the space as they're kind of doing their evaluations? What would you say about the availability and the use of social from that standpoint?
Yeah, I mean, there's some good stuff out there. I know people producing things on YouTube.
Yep.
There's some good stuff. Most of the stuff with the, I mean, I'm involved with LinkedIn and Instagram and those things, but I don't know that there's how much educational value there is on those little splatters, but you could kind of see what people are doing. And, I guess social media is a double-edged sword. I mean, it's something I use because I need to get out there so people get to know me.
Yeah.
And if you're working to have people invest with you, people need to know you first. And so we put ourselves out there so people will know us, and then they get the opportunity to meet us and possibly down the road trust us and want to invest with us. But it's not my favorite. Social media is not my favorite thing. I would rather be on a phone or a Zoom call with investors talking about the business and talking about their goals and how we can help them along their path.
Okay. And also, I know, Jeff, you're a frequent goer of conferences as well. I see you participated in one there just a couple of weeks ago. That was in Salt Lake City. So you like going to conferences and putting names to faces and interacting with individuals in that regards as well?
Yeah, conferences are great. You just need to have a plan when you're going to a conference as to what it is you're trying to accomplish. A lot of these conferences have some great speakers, great information. But if they're recording it, you can get the recording later. You could get the value out of that. You could get that later. I think the greatest value of conferences and seminars and those kind of things is the networking, is being able to get face-to-face with people that could team up with you in some way or another. Either someone that maybe can find deals for you. Maybe they have good broker relationships. Maybe they run a management company or whatever. It's a good time to network. And networking is very important in this business. So that's the best thing with the conferences.
Jeff, I appreciate you dropping the nuggets of knowledge over here to the learner base. We appreciate it so much, man, and sharing information about your fund, what you look for in terms of individuals that you choose to partner with, and also some of your goals and nuggets of advice for user bases who are thinking about getting into this space from an investment standpoint. So again, folks, Jeff Greenberg, the true gentleman of getting diversified and all his actions and things that he do. So Jeff, on behalf of myself, my wife Jacqueline, and the team here at Moreland, we appreciate you joining us here today.
Well, thank you. And I have a gift for your listeners. It's questions to ask a deal sponsor before you come in, if you're coming in as a passive. Mm-hmm. Now, it also can be used if you're an active investor, just to be able to look at the questions that somebody else may come and ask you, to be prepared to answer. So either way, if you're planning on being an active investor or a passive investor, so you can get that at sigcre.com/sponsor. And you can get the information and make you think about some of the things that you're asking deal sponsors and what your expectations are before you get into those deals.
All right, Jeff. Make sure we add those to the show notes and that it pops up on the screen here at the conclusion of the podcast. That's what we appreciate it, Jeff. Thank you so much.
Okay. Well, thank you for having me.
Hey, man, thanks. We appreciate it, Jeff.
Jacqueline and Melvin, thank you so much for taking time out of your busy day to listen to this episode of Get Diversified. Please make sure to subscribe to our podcast so you don't miss out on future episodes. Finally, stop by our website and follow us on social media. Ciao for now. Make it a great day, and we'll see you next time And remember, get diversified.